Is going on, guys? Your favorite mortgage lender, Abdel Khawatmi. Give it a couple seconds to go live on a few platforms, and then we're going to get cranking away. Boom. All right. Hope you guys are doing well. Man, I got a lot of things to talk about. Obviously on today's episode, we're going to be going over all the different mortgage scenario options that we've been going through this week. We also know that inventory has been kind of tickling up. I shared a video earlier today. We were going over home inventory and the little bit of an uptick that we saw, 3.2 months of supply that we're starting to see. We're almost as low as 2.9. So a little bit of a good thing in regards to that. Now, what is currently going on with interest rates? Interest rates are kind of taking a little bit of a turn to the opposite. I think they're being a little volatile right now. Next week is going to be a massive report with the PCE report. Personal Consumption Expenditures Report. That is the Federal Reserve's favorite gauge when we talk about interest rates, when we talk about expectations within the market. So we're going to truly kind of keep an eye on exactly what we have going on and taking it from there, right? So one of the scenarios I wanted to talk about, and I have my little cheat sheet here because I wanted to go over some things. We've got a FHA 203K loan going on right now. For those of us who don't know, a 203K loan is a loan where you actually purchase the property with just a regular FHA loan, but then you also have the ability to loop in the repairs of the financing repairs within it. So we're actually in the process of putting in that loan together. We've got the contractor together, the consultant together. We're trying to squeeze it for this month. But let me tell you, there's a lot of different avenues that go in within an FHA 203K loan. We talk about first finding the right contractor and the right consultant. So luckily, this contractor is not naive to the process, very, very familiar. We've done a couple transactions together in the past, extremely responsive when we need some updated documentations with the contractor profile and the work itself. Then it's also the HUD consultant. The consultant is also, their role is to check the contractor's work and make sure that whatever they're estimating in regards to their repairs matches the scope of work. And you have the ability to match what's called the bid and take it from there, right? Now, what we had actually these contractors do was we had it updated where it's going to be not habitable. So because the client is doing a decent amount of work to the home, we actually had them update the bid to say not habitable. This gives the consumer the opportunity to not have to make a mortgage payment while the home is being repaired, which is crucial, right? The last thing that you want to do is purchase a home and then be stuck with having to pay both a mortgage payment and a rent or two mortgages at the same time. So we strategically advise the contractor to make sure that he updates the bid, puts it as not habitable, which is true. The house is not going to be habitable while they're doing the repairs, okay? So critical for you to be able to do that. I've had some instances, even in my past, where I thought it was automatic that it was not habitable and a contingency reserve was created, and it actually backfired. Luckily, the contractor was able to finish quickly, and we were able to set the proper expectations from there. And it happens, and I'm super, super meticulous, but sometimes things occur, right? Another one I wanted to talk about also was we were able to get a client into a conventional loan with a non-occupying borrower. I was super, super, super cautious when we were setting the proper expectations with the client, setting the proper expectations with the attorney. We got the loan approved in less than a week. We were able to set the proper expectations. I believe they just recently had the inspections. On our end, though, loans approved, inspections done, appraisals done, I should say. Appraisal came in, conditions are pretty much cleared, and now we're ready to get this one cranking away and rock and rolling. So the importance of why I'm sharing this specific scenario is that less than 2 weeks ago, I really did not know if we were going to be able to get the loan approved, just mainly because we added a non-occupying borrower. And I've shared this scenario with us before. This is something that we do consistently in the past. It's just a matter of setting the proper expectations when it comes to that stuff, and we're able to push it through. A different scenario we wanted to go over specifically was a client who was purchasing a conventional loan. Remember, guys, the parameters on conventional loans have now changed to 5% down for multifamily 2 to 4 unit properties. This is now giving us the client the expectations to be able to purchase a home. No self-sufficiency test being needed, which basically means that you do not need to have any rentals cover the mortgage payment, which is one requirement generally with FHA, and we're able to offset the difference from there. What else do we have going on this week? We're dealing right now. We've got these 3 condos that we're actually trying to put together and figure out how we can get the FHA sustainability, the condo approval to go through. And it's real difficult right now because condos in Florida, since the condos that fell with sunset in I think it was 2021, it's created a huge ripple effect when we talk about that. Yeah, Eric, so I'm getting to that FHA spot too. But created a huge ripple effect when we had the structural life and safety issues are the two main things that has changed since 2021. And these condos are under direct scrutiny with whatever it is that they have going on when it comes to that stuff. Right. So hopefully we've been going back and forth. We're working on it's 3 different properties, 3 different refinances. We're working on trying to get an exception actually on all 3, mainly because of this life and safety issues. I mean, these, it kind of sucks because the buyer bought the property, but he's really having a difficult time. And if I can't get it done, I'm sure half the people on this call can attest to it. Not many will be able to do it thereafter, right? So hopefully I'll keep you guys updated on that one probably by next week on our scenario calls, and then we'll take it from there. Erickson mentions an FHA spot approval. That's actually a current deal that we have going on right now. I was able to successfully get one done about a week ago or 2 weeks ago. We closed for a very good colleague of ours who was actually referred by a realtor purchasing a property that he was currently living in. So it was a FSBO. We were able to set up seller's concession strategically up front. So the client actually was able to literally buy the house for less than he would if he was to move into a brand new apartment and pay rent with the security first month, last month, along with a rental. He ended up buying the house. I think he ended up bringing like $11,000 all in to the closing table. So he was obviously happy on that part. And the house over appraised by another $5K on top of the $10K concession that we got him. So super happy about that. We had to go FHA because the condo was only $260,000. Conventional only allows you to borrow up to 3% seller's concession if you put less than 10% down. So in this case, the client wouldn't have the necessary cash to close and he can't buy the house. So what we did was we did an FHA single unit condo approval, also known as an FHA spot approval. Basically what it does, and I always like to call it the single unit condo, because that basically means you're approving the 4 walls of that specific association to be FHA approved. Now, it is extremely tedious, but we have had consistent experience in the past of getting it done, and we were able to get that one done. Now, for this particular client, we got a lot of parameters going on. Putting the property to the side, just the client themselves, when it comes to their eligibility, they were just unfortunately not necessarily being prepped correctly with their loan officer. Because once I grabbed the file, I was immediately able to identify, hey, we're going to have a potential debt to income issue, which basically means that what the client makes versus what the potential total debt she has revolving is against her. We're able to set that expectation. Another thing we're able to do, this is all, by the way, the same day, and the realtor can attest to this literally because he's probably listened to this. The same day we're able to set the expectation that this client had a car that's right about to expire. And with the car that's right about to expire, it's a lease. So what kind of sucks is if you purchase a vehicle and it's a finance car and you have less than 10 payments, we as the mortgage lenders can actually exclude that payment from the borrower's debt to income, right? Because you're essentially going to pay it off super quickly. On a lease, though, when you have a leased vehicle and it says it on your credit report, auto lease or finance, we are not able to exclude it, mainly because you're probably going to return that lease and still incur an additional liability. So what we were able to do was we prepped the client in advance that, hey, got to return this car, which she was in the process of potentially doing so anyway. And then what we did was we set the expectation that, hey, all right, she's going to return this car. You got to get something cheaper. So she's currently paying about, I think, like $650 or $670 a month. She's returning the car and getting something for $400. Now, obviously, not necessarily we don't want a client to downgrade, especially nowadays with car prices. But buying a house obviously gains appreciation. Buying a car, as I'm finding the hard way now with my truck, depreciates. And right now the car game is a little crazy, right? But the expectations going back to it was set from the beginning with the client. The client knew what we needed to do. Now, we were able to get this client approved very quickly. we're able to simultaneously let them know exactly what they needed to do in order to push through, and the expectations were properly set from there. And you will always hear me say this word, and I even catch myself a lot of the times, always saying expectations, expectations, expectations. It is so critical when you're a client to understand what's next, what's next, what's next. A lot of our times with our relationships with our clients, we're not sitting there and having you guess. You probably damn well know what's going on. And I would have probably done a video, as I have been the last 7 years of shooting content of doing something, and I'm probably going to provide it to you and provide you video and visual, tongue twister, video and visual PDFs that confirm the same. Okay. So there's no guessing time frames that you have. Okay. We have another client that we're doing, and I'll wrap it up on this one with a DSCR loan, debt service coverage ratio loan. The client's in the process of purchasing a property, or I should say, purchase the property in cash. We're doing a cash out refinance, 75% loan to value. The client's going to be getting their money back, and at the same time utilizing the money that they're going to get back for another property that we already have in mind. I do a lot of these type of loans with our partners and a lot of our clients, because it gives them the ability truly to be able to set the proper expectation. That's, all right, I'm going to go and buy this in cash. I don't want to necessarily stretch myself in cash, but that's going to give me the competitive advantage, whether I'm buying it in an auction or foreclosure or whatever. And then they're simultaneously able to return their money back by less than 25%, basically 75% LTV. And a lot of the times when they buy this, it would have did a little bit of work to the home as well. As long as the house is paid off completely, we could take out 75%. If the house is not paid off, we can only do a rate and term refinance and change institutions, which we do a lot. Sometimes we'll have clients who have a take out a fix and flip loan, right, which are usually super high interest rates and usually have shorter terms. We have them take it, get the loan, fix the house, and then simultaneously they will come back and we will be able to do a rate and term refinance, rolling in the closing costs, rolling in what they currently owe to the lender, and replace it with an interest rate anywhere from 7 to 8% as the market is currently sitting at right now. So appreciate you guys jumping in. I will obviously share this on our YouTube channel and all of our social media channels as well. I'll catch you guys next time. Hopefully we'll start seeing a little bit of fluctuation within interest rates. I think it's going to be a flat week. But next week, the PCE report, personal consumption expenditure reports, is definitely going to set a little bit of an expectation in regards to what we're looking to see. I'll keep you guys updated. Have a wonderful night. Talk to you guys soon.